This is the second video in my financial ratio series, and in the first video we went ahead and gathered the necessary data. We're doing some analysis on ratios for Pepsi. So if you haven't seen that video and you want to see where the data comes from, you can go to that. That data was from your guided tutorial handout in Canvas, or if you're not in my class, you can get those financial statements for Pepsi downloaded from the following bit.ly address. But when we went through and gathered that data, we gathered all the data that we needed in order to calculate the financial ratios that we're going to go through. Now I'm going to break these ratios into two more videos because it takes a while to go through each of the calculations. The first one, we're going to start with our liquidity ratios, our asset management ratios, and then our debt management ratios. Liquidity ratios are ratios that typically are used as a tool by short-term creditors to make sure that the companies have enough assets or enough current assets to pay off any short-term loans or credit that they extend. However, it's also going to be looked at by stockholders, by management, and by long-term debt holders. Stockholders are concerned because if the company can't make its short-term credit payments, it's not going to be around to make its long-term payments and be solvent to pay stockholders. Debt holders, same idea. If the short-term creditors can't get paid, then the long-term creditors aren't going to get paid. And management has to focus on this because it's their responsibility to run the company and make sure they remain solvent. First ratio that we start with is the current ratio. Very simply takes current assets divided by current liabilities. Current assets are things like our cash, accounts receivable, and inventory, things that we expect to either be cash or converted into cash within the next year. Current liabilities are things like accounts payable, short-term loans, accruals, things that we're going to have to pay within the next year. So we want to make sure we have enough cash, or things that are going to turn into cash, to pay off our current liabilities that we're going to owe within the next year. And when I say within the next year, sometimes that may be within the next couple of weeks, it may be within the next several months, so it's going to vary depending on the specific type of current asset or current liability. But our data from Pepsi showed our current assets at $17.441 billion and our current liabilities at $18.154 billion. So when we calculate this ratio, we just take the 17.441 current assets divided by the 18.154 billion current liabilities. Get out a calculator. 17.441 divided by 18.154. It's going to give us a current ratio of 0.96. Now normally this is a relatively low value for our current ratio. We'd like to see that be higher than 1, and a lot of people want to see it somewhere in the 1.5 or 2 range for a current ratio. Have a little bit of cushion instead of just enough current assets to meet our current liabilities. Now we're probably a little bit less concerned in Pepsi's case because Pepsi has very stable, predictable revenue generation, and so a lot of their cash that they're going to use to pay off current liabilities hasn't been even generated yet, or doesn't show up on the balance sheet. They'll generate sales, they'll turn those sales into cash. So some companies are a little more worried about that current ratio. Other companies like a Pepsi or a Walmart, where they have stable, reliable cash flow generation ability, we're probably going to be able to feel comfortable with a little lower current ratio. Now the quick ratio is also something that's designed to look at our short-term credit situation, our ability to meet our current liabilities, but now we're pulling out the inventory. The idea is inventory is one of the least liquid of our current assets. In order to generate cash from inventory, we have to first sell it, and in many cases if we sell it on credit, then we have to collect it. So some people say, let's be conservative, let's assume this inventory doesn't turn into cash in the near term. Can we still meet our current liabilities? So let's look at Pepsi again. Their current assets, as we already know from before, are 17.441 billion. Their inventory, which we collected on our sheet in the last video, is 3.827 billion. And their current liabilities were the 18.154 billion. So get out our calculator, clear out the last one. 17.441 minus 3.827 divided by 18.154 is going to give us a quick ratio of 0.75. Again, this is a relatively low quick ratio. Most people want to see that quick ratio be greater than 1. Pepsi is below 1. At first glance, if you see a quick ratio of 0.75, you might be concerned about a company's ability to meet their short-term debt obligations, but we're probably less concerned about that given the structure of Pepsi. Just like we were less concerned about the current ratio, a little bit less concerned about the quick ratio. Companies with stable, predictable cash flow generation power, especially large companies, are going to be able to get by with a little bit lower values for their liquidity ratios. Next up, we've got the asset management ratios. Asset management ratios kind of look at how well the company is doing at generating sales from its assets, or how well they're managing some of their assets. Inventory turnover takes a look at cost of goods sold divided by inventory. Now, ideally, we want to move through our inventory quickly. Higher inventory turnover ratios are better. So if we're able to generate a situation where we move through our inventory several times within a given year, we're able to generate more profits off it. Now, inventory turnover I've seen used different ways in different books. Some books use cost of goods sold as the numerator, some use sales as the numerator. I think there's arguments made for each. One of the problems with sales is that it doesn't really reflect the cost of the inventory, it includes your profit margin. One of the problems with using cost of goods sold here is one reason we might see a higher inventory turnover is if we have a higher cost of goods sold. A company with a lower inventory turnover ratio using cost of goods sold might have a higher inventory turnover ratio using sales because they're able to get better profit margins. So I think you can make an argument for either approach. However, in this class we're going to use cost of goods sold. It seems to be a little more commonly used. So we need our cost of goods sold. We collected that as $31.593 billion from the 2011 income statement for Pepsi. And we also need our inventory, which we collected from the 2011 Pepsi balance sheet at $3.827 billion. So let's go ahead and set that up. Our inventory turnover is equal to the cost of goods sold, which we said was $31.593 billion, divided by the inventory, which we said was $3.827 billion. Go ahead and do that calculation. Got 31.593 divided by 3.827, and that gives us an inventory turnover ratio of 8.26. Now, all else equal, we'd like that inventory turnover ratio to be higher. However, in order to evaluate whether or not it's good, we really need context, because different companies, based on their industry, the type of business they're in, are going to have very different inventory turnover ratios. So here's a situation where ideally, in order to determine is this a good or bad number, what we need to do is make some comparisons. How does it compare to Coca-Cola? Also, how does it compare to Pepsi last year and the previous year? What's the trend going on? So the context is going to really help us interpret whether or not this is a good value or a bad value. Next, we have days sales outstanding, which looks at how long it takes a company to collect their sales. So we've got accounts receivable divided by sales per day, just sales over 365. Now, again, ideally this is a number that we'd rather see be lower rather than higher. Too high indicates we're having problems collecting our credit sales, and if this day sales outstanding ratio gets too high, that may mean our customers are not paying. We may have more bad debt expense and have some write-downs coming in the future. But even if they pay, the longer it takes them to pay, the less the money's worth to us, time value of money. So ideally we'd like this to be low. But as with all ratios, we always have to be careful. We don't want to say let's minimize the days sales outstanding, because the easiest way to do that is don't sell anything for credit. If you don't have any accounts receivable, your days sales outstanding is 0. But that might mean a lot of lost sales, customers who no longer buy from you because they can't purchase on credit. So you've got to balance out that idea of generating cash flows from your sales with how long it takes you to collect those sales. Let's go ahead and calculate the days sales outstanding ratio for Pepsi. Our accounts receivable we gathered from the 2011 balance sheet at $6.912 billion, and the sales we generated from the 2011 income statement at $66.504. So our accounts receivable 6.912 over sales per day 66.504 divided by 365. First thing we need to do here is calculate what our denominator is going to be. 66.504 divided by 365 gives us a value of 0.1822. So 6.912 divided by 0.1822. Then we can go ahead and do that last step. 6.912 divided by 0.1822, and that gives us a day sales outstanding of 37.94 days. Remember, day sales outstanding ratio is going to be in days, so it takes Pepsi a little over a month on average to collect their credit sales. Let me come back to that real quick. Again, is that a good or bad number? We can't tell at this stage. It's just a number. We need that context. Let's evaluate it relative to Coca-Cola. Let's evaluate it relative to Pepsi over the last few years. If that number has been rising rapidly and is much higher than Coca-Cola, it's a bad number. If that number's been stable or it may be dropping slightly, then it might be a good number. So we have to really look at the context in order to interpret a lot of these ratios. Next up, we have fixed asset turnover. Fixed assets a lot of times are just our property, plant, and equipment. So we want to take sales divided by property, plant, and equipment. In general, the better job we can do at generating sales from investments into our property, plant, and equipment, the more efficiently we're running our firm. So ideally we'd like this number to be higher rather than lower. So here we need our net fixed assets, property, plant, and equipment. And if they provide both gross and net property, plant, and equipment, you want the net here, not gross. 19.698 billion. And we also need our sales, our revenues at 66.504 billion. Go ahead and do the calculation. 66.504 divided by 19.698. It's going to give us a value of 3.38. And again, context is how we're going to interpret that. We want it to be higher rather than lower, but what's a good value? We need some comparisons of competitors, industry average, what has the company itself done in the past in order to interpret that. Total asset turnover is a very similar ratio. Now though, instead of looking at how well we're doing at generating sales from our fixed assets, our property, plant, and equipment, we're including all our assets. So total asset turnover is just sales divided by total assets. Our sales we've already reported earlier with our fixed asset turnover, just the 66.504 billion. Now we need our total assets. Total assets come from the balance sheet, 72.882 billion. Gives Pepsi a total asset turnover of 0.91. And again, we want that to be higher rather than lower, but in order to evaluate whether that's a good number or a bad number, we need the comparisons. We need to compare it to the industry average or to primary competitors. We need to compare it to what it's been over the past. The last type of ratio we're going to analyze in part 2 of this video series is our debt management ratios. How well is the company doing at managing or controlling its debt financing? First ratio we have is total debt to total assets. Just how much debt are we using to finance our company? What proportion of our total assets are being financed from debt financing? So our total debt to total asset ratio is just going to take our total liabilities, which come from the balance sheet. Here we see our liabilities at 52.294 billion. Divided by our total assets, which we introduced earlier at 72.882 billion. Go ahead and do that calculation. And we get a total debt to total asset ratio of 0.72. Can think of that in percentage terms. 72% of our total financing is coming from debt. Now that's a relatively high number. Normally we'd like to see that be a little bit lower, but we have to be careful in interpreting this. High total debt to total assets is not necessarily bad. It's a little riskier. It's using more financial leverage. Financial leverage can be good. If we're profitable, that means that more of our income is going to be going to our shareholders, and that's our primary goal: maximize shareholder wealth. So if debt financing is relatively cheap and we can do it without causing excessive risk to the company, that leverage can really be beneficial. The downside is if we start to get into financial troubles, that debt requires our interest payments be made. We have to meet our debt obligations or we can go into bankruptcy. If this were a company with high degrees of business risk, very volatile sales or labor situations, are very dependent on success or failure of new product introductions, I'd be concerned about this ratio. A company like Pepsi, very stable, well-known company, good credit ratings, and that, probably a little less concerned. Again, for context, we want to evaluate it relative to the industry norm, look at how it's been over history, but remember, it's not automatically bad to have a high value. It's riskier. Companies with low levels of business risk, predictable sales, can usually get by with a little bit higher level of financial risk, a higher total debt to total asset ratio. So Pepsi would probably be okay with this. However, it's still getting a little on the high side. I'd be a little concerned if that started to get too much higher. Another way to look at their debt management is how well are they meeting their interest. If they can cover their interest payments easily, then we're a little less concerned about this total debt to total assets ratio being high. And so that ratio just takes their earnings before interest and taxes divided by the interest. Now the reason we use EBIT here instead of net income is because the more interest that they pay, the less they have left over, the less taxes they're going to have. So this is a better measure of their ability to meet their interest expense than their net income. So let's calculate that times interest earns ratio. Our earnings before interest and taxes taken from the income statement is 9.69 billion. And their total interest expense is 0.856 billion. Go ahead and do that calculation. And we get a times interest earned of 11.32. What that means is that their current income, Pepsi is able to pay their interest payments more than 11 times, which gives us a little more degree of confidence in this higher total debt to total assets ratio. Part of this is because Pepsi's reputation, their low levels of business risk, allows them to borrow money cheaply. That keeps their interest expense relatively low. They can take on more debt without having problems. Companies that have to borrow money at higher costs, less reputation, more business risk, they're going to have higher interest expense, and that's going to lower their times interest earned. Ideally, we want to see this number be at least 2, maybe 3, 4, or higher. You might say, well, as long as it's 1, we can meet our interest payments, but then all of our money is going to pay interest. We don't have anything left over, and any downturn is going to cause problems. So I really am not comfortable with a times interest earned ratio of 1. I want to see it be significantly higher than 1. Last ratio we're going to cover in this video is the cash coverage ratio, which is very similar to the times interest earned, but now we're taking EBIT and adding back in depreciation. The idea here is we're not really paying anything for depreciation. It's not a cash expense, it's an accounting expense, and therefore our EBIT plus any depreciation, which lowered our EBIT, is actually available to pay interest. So this is a more finance-based look at, can we meet our interest obligations? So if we calculate the cash coverage ratio, our EBIT, which we looked at earlier, 9.690 billion. Our depreciation, now this actually comes from the statement of cash flows. Sometimes you won't see that listed on the income statement. You might have to go to the statement of cash flows to get that depreciation. That's 2.737 billion. And our interest expense, as we talked about last time, was under a billion, 0.856 billion. Calculate our cash coverage ratio, 9.69 plus 2.737, divide by 0.856, gives us a cash coverage ratio of 14.52. And again, very high value here. Ideally, just like times interest earned, we want to see that be a little bit higher rather than lower. If it's under 1, we've got real problems, but we want to see it be higher than 1. 1 is not a good benchmark because, again, that doesn't leave anything left over. We want to see it probably 2, 3, 4 or higher in order to start feeling comfortable with the cash coverage ratio. But again, that's going to vary depending on company and industry. So that's where context, looking at trends, looking at comparisons to industry averages, our major competitors can come in real handy in evaluating that ratio. Our next video is going to look at our profitability ratios and our market value ratios. So one more video in this financial ratio series.